Kevin, go to you on this one. We saw a big move in the 2-year yield today, and investors are starting to get used to this idea that we might not get rate cuts from the Fed until the second half of next year. So how does that factor not just into the action we saw today, seesaw, but where we go from here?
Thanks for having me. I think that's the right conclusion, that inflation is going to remain high and sticky, and the rate cuts that were priced in through the end of next year about a month ago are not going to come to pass. And the additional fiscal deterioration is just adding to that narrative.
Okay, so Keith, tragically, we've got this news headline of a deadly blast at a hospital in Gaza. So it looks like this war in the Middle East is escalating. Palestinian authorities saying hundreds were killed. The human toll, of course, is the first focus. If this war does continue to escalate, what sectors are most vulnerable?
Yeah, I mean, I would say so far, I will just say that this market has held up remarkably well in light of what's happened. As you said, it is a tragedy. And part of that, I think, as you think about the impact, is a lot of this tends to manifest itself in what does this mean for the global economy and what happens to oil prices. So I think, naturally, a natural hedge and a sector that we've been overweight for several months now is energy. Energy is one of the cheapest sectors. It's trading at a huge discount to the overall market. It has one of the strongest earnings revision trends. And the bottom end of the oil range is likely to stay higher. So I think that's one area that we want to stay. And then on top of that, industrials, especially the defense area, is another area we've been overweight before this. And that reinforces the kind of some secular trends as far as defense spending. But also a lot of the fiscal stimulus is still going to trickle in over the next few years. So those are two areas that we continue to like with some of the geopolitical uncertainty.
Kevin, anything you see outside of those two?
I would agree with what Keith said, and I think there's going to remain pockets in tech that will have robust fundamentals. The AI investment dynamic is going to continue unabated, irrespective of the geopolitical.
Speaking of tech, Kevin, even though the overall indices kind of seesawed up, down, up to about break even, there were certain tech names, particularly in software, that seem to just end up a lot higher. Some of the riskier names, C3 AI up 6%, Affirm up nearly 6%, et cetera. ServiceNow did pretty well as well. What does that say to you?
I think it reiterates what I just mentioned, that it's a very powerful investment theme. Companies like Microsoft, C3 AI are extremely levered to that theme. It's going to be a mixed bag. We've seen weak results elsewhere, for example, in IT services, hardware, et cetera. But this is a very strong multi-year trend, which is going to benefit some companies.